Hi, everyone. I'm Don Messer, the Executive Director of the Center for Health and Hope in Centennial, Colorado. What a joy it is to welcome all of you to our webinar entitled Doing Good in This Life and Beyond. Persons on 3 continents, Europe, Africa, and the USA, are joining us in this rather unique conversation. The webinar is sponsored by the Center for Health and Hope. For those who may not know us, we support projects around the world that reach out to the most stigmatized, marginalized, and impoverished. On our website, www.Center for Health and Hope, we share stories and ways we especially care for persons infected and affected by HIV through programs of education, prevention, care, and treatment. Today's purpose, however, in this webinar is not to highlight those urgent needs, but rather our purpose today in gathering is to reflect on how each of us can plan for our futures. All of us know that life is precious and can be precarious. We live daily in gratitude to God and to others. All of us have sought to do good throughout our lifetimes, and most of us want to leave a legacy that makes a difference beyond this life. Today, the Center is sponsoring this webinar because we want to enable you to know more about your options in planned giving. Every person has a different situation, different needs, and different hopes. Therefore, no blueprint fits everyone. Obviously, the Center welcomes being included in your legacy thinking and estate plans. We are a 501(c) charity recognized by the federal government, with our own ID tax number, which we can provide to you. We need legacy gifts to carry on our mission of care to the impoverished and marginalized in the world. But believe it or not, our first priority is not the future of the center. What is more important to us is that you have accurate information and clear legal documents that express how you want to care for your family, friends, church, and other nonprofits. I've always found it very sad when my friends have died and they have failed to make clear written wills. Sometimes their resources have been used in ways that they might not have personally chosen. Too often they have waited and waited, always putting it off till tomorrow, and then suddenly it was too late. So today I encourage all of us to celebrate life by looking ahead and planning ahead. First, today we'll have a short testimony about one person's plans, and then I will introduce to you an expert from the University of Denver who will share about planned giving, and then at the end he will answer some of your questions. You can submit them in the chat section, or you can share them live as time permits at the end. Now it's my great pleasure to introduce my friend, Dr. Suzanne Hamm, a retired child psychologist. A member of the Center's Board of Directors, Dr. Hamm has devoted her life to caring for individuals and championing social justice. Dr. Hamm, thank you for being with us.
You're welcome. Thank you, Don. Good morning, everyone. It's a pleasure to be here and to share a few minutes of our time together talking about leaving a legacy of love and life and planned giving. I'd like to share some personal information with you first. Yesterday, I celebrated my 80th birthday with family and friends, and a good time was had by all. I continue to be well and have and continue to live in my mountain home, which my husband and I built 50 years ago. How time flies when you're having fun. One thing I love to do is every morning when I get up, I go to my favorite chair where I overlook the Continental Divide. And then I spend about 30 minutes giving thanks for all the blessings in my life. I find it's a wonderful way to start the day, giving thanks for my love and laughter. One of my blessings is the Center for Health and Hope. I've been blessed knowing people, wonderful people, who are truly making a difference in the lives of orphans and folks struggling with HIV and AIDS. And all around the world. This was the catalyst for me becoming interested in the living legacy. I just revised my will this past month, and I checked again to make sure that I am giving 10% of my estate to the center. Since being on the board of the Center for Health and Hope, I've had the privilege of seeing firsthand how the donated money is spent. I'm here to tell you, all money is spent, no money is at all is spent on administration. All the money is used for helping people directly. The thought that this goodness can live on after I am no longer on this earth is a real comfort and a blessing for me. Leaving 10% of my estate to the center is no big deal. It still leaves 90% for my family and loved ones, as well as other charities that I support. There are many ways to give and many different options. We are really very privileged today to have Mr. John Kraus, who is a specialist in this area, who can really give us different options and explain how this process works. I'd like to leave you with these words from Amy Carmichael. One can give without loving. One cannot love without giving. Thank you very much, and I look forward to hearing what John has to say about planned giving now. Thank you.
Thank you, Dr. Hamm. That was really thoughtful and truly inspiring. And happy birthday to you as you celebrate your 80th.
Thank you.
All of what you said prompt us all to pause and to reflect on our own lives and our future. Now I'm excited to introduce our volunteer speaker for the morning, Mr. John Kraus. As Executive Director of Gift Planning for the University of Denver, he is a person of vision, of integrity, and of compassion. John has spent a lifetime sharing his experience and expertise in helping others make a difference by how they use their resources for other people. A native Coloradan, John's a graduate of the University of Denver and Regis University. Thank you for helping to educate all of us today about planned giving. John?
Great. Thanks so much, Don, for that intro. And thanks, Sue, for your comments. And thanks, Don, for inviting me to be with you here today. I appreciate it. I'm not quite a native Coloradan. I was born in Kansas, but I've been here for about 80% of my life. So I think I'm probably an honorary native at this point. But yeah, glad to be with you. A little bit of my background. So I've, as Don said, I graduated from the University of Denver. And has spent the last 23 years in financial advising and nonprofit development. In the last 10 years, I've been here at the University of Denver in the Office of Gift Planning. And so in my current role, I work with donors, advisors, attorneys, and several other university partners to educate our supporters on various ways to give to the university and to nonprofits in general. And to help them give in the most kind of impactful and tax efficient ways possible. And so I also have some connections to the center and United Methodist Church. So if you're wondering why somebody from DU is doing this presentation, but some of you may know University of Denver was founded by the Methodists back in 1864, and our original name was Colorado Seminary. And we changed that to the University of Denver in the early 1900s. And so it was only a few years ago that we officially were able to change our name with the IRS. And so up until a couple of years ago, my pay stub still said Colorado Seminary. So, but we do share a campus with the Iowa School of Theology, where Don was for many years. And you know, Don lives in our neighborhood. And so through the local HOA newsletter, my wife and I had seen that he needed a little help, and so my wife got involved with the center, and I've since gotten involved in different ways. And so it's been great to get to know Don better and learn the mission of the center. And so that's part of the reason why I'm here today. If you know Don well, you know that if he's very persuasive. So if he asks you to do something, it's hard to say no, and it seemed like a great opportunity just to share some of the things I've learned in my experiences in gift planning, and also connect back to the mission of the center. So with that, well, we can just dive right into the presentation here. Let's let's see. There we go. Okay. So here's our agenda for today. It's fairly simple. We'll just start with a little bit of a primer on plan giving and defining what it is and kind of what we're talking about. And then we'll talk about some different ways to give, you know, now and in the future, ways that you can give and receive income in return. So I'll cover, you know, quite a bit of information, you know, in a short amount of time, and certainly these slides will be available afterwards. I know the recording will be available afterwards, so don't feel like you have to write all this down. But as questions pop up along the way, as Don said, feel free to put those in the chat, and I will get to them later, just so I can get through as much of the content of the presentation as possible. Or you can jot them down, and at the end, I'll stop sharing the presentation, and we can just have some general conversation. So I'll try to leave at least 10 minutes at the end for that. Whoops, I went ahead too quickly. Yeah, I think other than that, I believe everyone is muted now, but you know, feel free to put yourself on mute, or for now, just for the presentation part of it. And at the end, we can invite you to unmute. Unless there's anything technical or you can't see or hear me or whatever, then come off mute and raise your hand, and we can fix some of the technical issues, just so that we can do that along the way. So, all right, so what is plan giving? So I generally don't like to read from the slides, but I'll just go ahead and read this out loud. So it's a definition I found several years ago, and I think it's a pretty good one. So a planned gift is any gift made in lifetime or at death as part of a donor's overall financial and or estate planning. By contrast, gifts to the annual fund or for membership dues are typically made from a donor's discretionary income. And while they may be budgeted for from year to year, they are not necessarily planned gifts. And another very simple definition, and much shorter, is any gifts involving non-cash assets. And so I think when people talk about planned giving, and certainly when we talk about legacy giving, there's this thought that they're gifts that come after someone's lifetime. But I think if we think about planned giving holistically, in terms of any gift that involves any kind of planning, so any gift that involves tax planning or involves your financial advisor or your estate attorney, it can open up a lot more avenues for planned giving, and generally giving in more tax efficient ways as well. So that's kind of my definition of planned giving. So not just bequests and estate gifts, but anything that involves kind of non-cash assets or things that are not part of your discretionary income. And why is this important? You know, why is planned giving important? You know, there was a study of assets done a few years ago now, but it's probably fairly similarly accurate now, just in terms of the types of assets that individuals hold in the United States. And so you can see by generation what those assets are. Obviously, the largest chunk of assets held in the United States right now is the baby boom generation. And over the next several decades, you know, if you add kind of the silent generation, the baby boomer generation, it's over $80 trillion. It's estimated to pass from one generation to the next over the next several decades. And if you look at where people hold their assets, so, you know, the darkest bar is real estate, then you have stocks and mutual funds, and then you have retirement and pension funds. And then that light gray bar is other. And so that would be, you know, pretty much anything else that people hold, including cash. But if you look at what people hold in cash, it's a very small sliver of that light gray bar. And so it's estimated that, you know, individuals of wealth only hold about 3% of their assets in cash or cash equivalents, and the other 97% are held in other assets. However, when a lot of people think about their charitable giving and they're doing their budgeting and where they're going to give from, a lot of people are looking at, you know, what's in their checking and savings, or what's their discretionary income. And if we're looking at that, we're only really considering 3% of the picture, and we're not looking at the other 97% of assets that could be potentially used as gifts either now or in the future. So that's what we're going to be talking about today, is kind of how to unlock some of those additional assets, both to increase the impact of your gift and also maybe to save on some taxes as well. All right, so first we're going to talk about current gifts. So we're going to talk about a few different types of plan gifts where you can make a current impact, and we're going to start with gifts of stock. How this would work is if you own stock and particularly appreciated stock. So certainly we don't ever want to give depreciated stock. If you do have depreciated stock, the best thing to do is just sell it, take the tax benefit from that and give the cash. But what works the best is if you have highly appreciated stock, you can give that directly to the charity and receive a full charitable income tax deduction in return. And so you would receive basically the same charitable deduction that you would receive if you gave that amount of cash. However, the added benefit of giving stock is that you avoid all capital gains. And so here's how that would work in practice. And so if you were to, say you wanted to make a $50,000 gift to charity, and I put some sample tax rates in there. I know they're kind of changing all the time, and they've changed in the past few years. But if we think of somebody who has a 35% ordinary income tax rate and is in the 20% capital gains rate, if they were to give cash to an institution, they would receive a charitable deduction for 35% of that, and so they would get $17,500 back on their taxes if they itemize. And so the net cost of the gift to them would be $32,500 after taxes. However, if they have highly appreciated stock, let's say you bought, Apple stock several years ago when it was, when the stock price was quite a bit lower, and you bought that at $10,000. Well, now those shares are worth $50,000. If you sell that stock, you're going to be subject to capital gains tax of 20% on that gain of 40,000. So the difference between the 10,000 and the 50,000. However, if you give that stock directly to charity, not only would you get the charitable deduction for the full fair market value, so that $17,500, same as cash, but you would avoid paying $8,000 in capital gains taxes. And so just by giving a slightly different way, by giving appreciated stock versus cash, you could potentially save, additional $8,000 in taxes. And so when we talk about the net cost of the gift, it would cost you a little under $25,000, so less than half of the actual gift amount to make that gift of stock because of the capital gains that you're saving. And I will note, I checked with Don ahead of time. I do know that the Center for Health and Hope accepts gifts of stock directly. They do have a brokerage account, and they're able to accept those. And Don has all of that information. And so feel free to reach out to him. And there's information on the website as well. And so if you're interested in doing that, he can certainly provide you with the information to do that. The one other piece that I like to mention about gifts of stock is if, let's say you do have Apple stock or some other kind of stock that you've held for a long time and you really like the stock, you think it's going to continue to do well, you don't necessarily want to give up that stock out of your portfolio. Or it could be that maybe giving a certain stock or mutual fund would make your kind of portfolio be out of balance in terms of different sectors or different portfolio allocations. What you can do is take that cash, if you have that cash and you're planning to make a gift of cash, give the stock instead, take the cash that you were planning to give to a nonprofit organization and repurchase that stock. There's nothing in, there's nothing in stock trading rules that says that you can't gift a stock and immediately repurchase it. The only rule is that if you sell a stock at a loss, you have to wait 30 days to repurchase it, but that does not apply for charitable transfers of stock. So this is what we call the charitable swap, is you're basically swapping out cash for stock, and by rebuying that stock immediately after you gift it at the current price, you're resetting your cost basis to a much higher level, and so you're going to be subject to a lot lower capital gains in the future. So that's something that some of our donors have chosen to do if they want to keep their stock portfolio kind of intact as it is. All right, so charitable gifts of real estate. So similar to a gift of stock, if you have, let's say you have a second home, you have a vacation home, you have an investment property. I know a lot of people, particularly in Denver, they may have rental properties that they've owned for a long time, and maybe you're getting to the point where you don't want to manage those properties anymore, or you have a second home that you're not utilizing and you want to sell that. But again, similar to stock, if you sell investment real estate at a gain, you're going to be subject to capital gains taxes on the amount, the difference between what you bought that property at and what it's worth now. So you could use that as a charitable gift. And so you can transfer appreciated investment property directly to a nonprofit organization. You'll get a charitable income tax deduction for the current fair market value, and you'll avoid all of the capital gains taxes you would have paid by selling that property. And it could be, maybe you're not able to donate the full amount, or maybe you want income in return. And so we can talk about other strategies that you can use real estate for other kinds of gifts. But this would just be if you're looking to make a significant gift to a nonprofit. This can be a really powerful way to do that. I recognize that smaller organizations, like the center or other small nonprofits, are not necessarily set up to accept gifts of real estate directly. But the good news is there's lots of organizations that are set up to receive those kind of assets. So there are community foundations, donor advised funds. There's a couple of local companies here. One is called Sharing Connection. And their sole purpose is to receive gifts of real estate. They will take title, they will sell the property, and they will provide the proceeds from that sale to a nonprofit or multiple nonprofits of your choice. And so if you're interested in that, my contact info will be at the end of the presentation. And so I'm happy to provide additional resources for some of these organizations that are set up to accept more complex gifts on behalf of other nonprofits. Again, because at the University of Denver, I'm blessed to have my own real estate team and to be able to accept, charitable gift annuities and all kinds of things. But that's not the case for probably 95% of nonprofits out there. And so I think taking advantage of these third-party vendors that are set up to do these kind of gifts is a good thing. All right. So moving on to gifts from IRAs. So this is one of my favorite types of gifts. I don't know if I know Don, I think you've probably done this. I don't know if others on this call have made these types of gifts before, but for anyone over the age of 70 and a half who has an individual retirement account, I think this is one of the best ways to give, regardless of the amount of the gift. It could be $500, $1,000, it doesn't really matter. And I'll talk about why that is here. So kind of how this works. You can either call it an IRA charitable rollover, you can call it a qualified charitable distribution or QCD from your IRA. So you may have heard different terms about this, but basically the rules of this are that if you have an IRA, it has to be a traditional IRA. So it can be a SEP IRA or a Roth IRA. It's got to be a traditional IRA. The donor has to be at least age 70 and a half at the time of the gift. And you have to make the distribution directly from your IRA account to the charity. And so you can't take the income first and then turn around and gift it, because once you take that distribution and take that income from the IRA, it's immediately going to be taxed at that ordinary income tax rate. The gift amount can be up to $100,000 annually per IRA holder. So if you're a couple and you have multiple IRAs, you can do this up to $200,000 annually, and it must be made to a qualifying public charity. And so that one of the rules about IRA distributions, they can't go into donor advised funds. And so this has to, the point of these was that they go directly to charity and immediately making an impact. And how it works is that because you are making that transfer from your IRA directly to charity, it actually counts toward your required minimum distribution. So let's say you're at the point where you're having to take out more than you need from your IRA. The IRS tells you every year, this is how, based on a percentage calculation, based on your age, based on the balance of your IRA, they will tell you this is how much you have to take out every single year once you hit, it's actually age 73 now, so they bumped that up a little bit. But if you don't need all that money, you don't want to pay taxes on it, then you can take a portion of that, transfer it to charity. It will actually count toward your required minimum distribution. But what it does is that by transferring it to charity and not receiving that income directly, you're actually lowering your taxable income. So I've got an example here. So again, we have a donor who has $100,000 required minimum distribution from their IRA, and they want to make a $10,000 gift to charity. Because this donor doesn't, maybe they don't have a mortgage, maybe they're not making a lot of other deductions that year. So, with the new tax rules a few years ago, the standard deduction is now, 12 or 13,000 for individuals and around $25,000 for couples. So you have to get above that amount to be able to deduct anything from your taxes. And the result is that a lot of people are just taking the standard deduction now, and they may still be making gifts to charity, but they're really not receiving any tax benefit for doing that if they're taking the standard deduction and they're not itemizing, because they may not be able to get above that standard deduction threshold in order to itemize their taxes. So in the first scenario, you have somebody who has a required minimum distribution of 100,000. They take the full RMD as they're required to by the IRS, and they turn around and they write a check for $10,000 to the charity. So a very generous donation. They feel good about it. Charity feels good about it, but there's no tax benefit because they're just taking the standard deduction and they're not itemizing their deductions. In the second scenario, the donor makes a qualified charitable distribution and they take $10,000 and transfer it directly to the charity. So now they've just lowered the taxable income to $90,000. They take that amount as their required minimum. And now they're only paying taxes on that $90,000. And so if they're in the 25% tax bracket, let's say, they've just saved $2,500 on their federal income tax by giving directly from their IRA versus taking that in cash and then turning around and making a donation. One of the other benefits of utilizing the IRA charitable rollover is that if you're lowering your adjusted gross income by making qualified charitable distributions to charity, that may benefit other things. So, like Medicare payments or other things that are tied to your adjusted gross income. If you're lowering your taxable income by making charitable transfers from your IRA, you can save in other areas as well. And so again, if you have an IRA, if you're over 70.5, it's a great way to give. I will just note too, there have been some changes to IRA legislation in recent years. So a few years ago, we had the Secure Act. Earlier this year, they passed the Secure Act 2.0. And what happened with that is that part of it was they raised the minimum age at which donors are required to take distributions. And so it used to be 70.5, they bumped it up to 72. Now it's 73, and in a few years it'll be 75. So that's good for IRA account holders who are kind of in that 70 to 75 range, is that you don't have to start taking money out until a couple of years later. However, neither the Secure Act or Secure Act 2.0 change the age at which you can make qualified charitable distributions from your IRA. So you can start doing that at age 70.5, which is good. All right. So the last type of current gift that we'll talk about is donor advised funds. And I know what you're thinking, this is the webinar, sponsored by the Center for Health and Hope, and shouldn't we be talking about how to give gifts directly to the center instead of setting up donor advised funds? Yes, absolutely. You should give directly to the center or whatever other charities you support. At the same time, there may be benefits to giving from a donor advised fund, and it may actually enable you to make larger gifts to the center or other charities. So the reasoning behind donor advised funds is that donors may want to make larger contributions in one year and then take standard deductions in following years, and then they can make gifts from these as they want to. And so again, with the increase in the standard deduction from the tax laws a few years ago, it's hard for a lot of donors to get above that amount and to actually see the benefit of that charitable income tax deduction if they're not itemizing. With a donor advised fund, you can, it's called gift bunching. And so you can bunch your gifts in certain years and have 1 year that's a high deduction year, and then maybe take 2 or 3 years off and take the standard deduction. And so what that would look like is you might give a large amount into a donor advised fund 1 year. That would get you above the standard deduction. You'd be able to benefit tax-wise from that. And then you would use that donor advised fund and make your annual gifts to charity over the next few years. And then maybe, in a couple of years, you do the same thing. You give a large gift to donor advised fund. If there are other deductions, mortgages or energy efficiency saving or whatever, you can pile all your deductions in 1 year, get as much tax benefit as possible, and then kind of take the next couple of years and take the standard deduction while you're still making regular gifts from that donor advised fund to charity. Donor advised funds can also work well with gifts of assets. So you can give appreciated stock into a donor advised fund. If anyone on the call has cryptocurrency, you can donate that directly into a donor advised fund. So the center might not be able to take crypto directly, but lots of the large donor advised fund providers are happy to take crypto and provide you a tax receipt for that. And then you can use that to give money to your favorite charities from that donor advised fund account. So that's why I mentioned that. And it can be, again, tax-wise, it can be a good way to give and takes advantage of some of those tax savings. So again, here's an example of how that could work. So a donor, makes a pledge to the center of $25,000. They plan to fulfill that over 5 years. So they're planning to give $5,000 a year for 5 years. And the donor is single. They have a $12,000 standard deduction. So they would have to get above $12,000 a year in deductions in order to start itemizing and seeing any kind of tax benefit. And so in the first scenario, they write a check each year for $5,000 to the charity. They take the standard deduction, and there's really no tax benefit to charitable giving. In the second scenario, the donor decides to make a one-time gift into a donor advised fund of $25,000. So by doing that, they are above the standard deduction by $13,000. They are able to receive an incremental tax benefit on that $13,000 and receive a charitable tax deduction. And so again, if they're in that 25% bracket, they're saving a few $1,000s in taxes that year by doing it that way. Then in years 2 through 5, they're continuing to make pledge payments by making distributions from their donor advised fund. And the one qualification of that is that it can't be a binding pledge. And so that's one of the things that donor advised funds currently can't fulfill binding pledges. But if it's a commitment, or if you say when you're making a gift that it's not in fulfillment of a binding pledge, then you're okay. But they'll continue to make those gifts in years 2 through 5. At the end of that period, then they'll have, been able to see that tax benefit. So just one example of how that could work with the donor advised fund. So we're going to move into deferred gifts. So those were gifts during your lifetime. Now we're going to talk a little bit more about gifts that can be made after your lifetime. And let me get to my right notes page here. There we go. So a gift through a will is one of the simplest, gifts that you can make through your estate. Sue was talking earlier that, she recently updated her plans, made sure the center was in there and that they're to receive 10% of her estate. And so if you have a will, if you're updating your will, a charitable designation is a great way to do that. It's very easy to set up. A lot of times you may want to go through an estate attorney, to create your plan or to update your plan. And that's what a lot of people do. If you have a very simple estate, or you're younger, or you just want to get something in writing quickly and then maybe have it reviewed by an attorney later, you can do that online now. So there's a website called freewill.com or freewill.org. I'm one of the two, where you can go and create an online will or estate plan in about 15-20 minutes. And it will prompt you and it'll ask you, would you like to include a charity in that? And so you can do that. It's legal in all 50 states. But again, you can always take that plan to an attorney and say, hey, can you take a look at this and make sure it's all, I've thought of everything, because it's meant to just be kind of very simple and for people who want to get it done quickly. But the good news is there are tools out there that will allow you to create or update your will or estate plan very quickly or easily. And as Sue said, this is a great way to make sure that all the people and causes that you care about are taken care of. And so what a lot of people will do is say, I want to leave, X amount to, my kids or grandkids or nieces and nephews. And then whatever's left over, I want to split up, and I want 10% to go here and 20% here. So that's called a residual bequest, where you kind of take care of all the things that you need to take care of, and whatever's left over can go to charity. Or it could be the reverse. You want to make sure that your charitable organizations are taken care of, and you say, I want to give, maybe you've made a binding pledge or some kind of pledge to the organization that will be fulfilled through your estate plan. So you could say, I want to give X amount to all these charities, and whatever's left, I want to divide up between, certain individuals. And so there are multiple ways to do it to make sure that, again, all the people and causes you care about are taken care of. Another deferred gift is just to name a charity or charities as beneficiary of different accounts that you have. And so these are referred to either as beneficiary designations or TOD, transfer on death gifts. So, anytime you set up an account, whether it's checking, savings, your stock accounts, IRAs, 401ks, it always asks who the beneficiaries are. So typically when you fill that out, it would be your spouse, or if you don't list anything, it just defers to your estate, and whatever's left would go into your overall estate. However, if you name individuals and or charities as direct beneficiaries of these accounts, the great thing about that is that it circumvents the estate and probate process. And so when the donor passes, any accounts that have a beneficiary listed, as soon as that account administrator or company that holds that account is notified, they have a duty to turn around and release those assets and make the payments to those individuals or charities within a certain amount of time. So those get distributed very quickly, and they do not go into the overall estate and probate process as the rest of the assets, within somebody's will or trust would. It's also very easy to update. A lot of, now that a lot of stuff is online. I know, I have a TIA account where my retirement plan is. I can go online, log in, click on beneficiary designations, and update it with, in about 5 minutes. And so it's very easy to name charities as beneficiaries of different accounts, either online or sometimes it's just a one-page form that you have to fill out, with your administrator. The last bullet point here on this slide is that for tax deferred accounts like IRAs, if you leave IRAs to non-spousal individual beneficiaries. And so for IRAs, you can always leave to your spouse and it'll pass tax-free to that spouse. If you're leaving it to anyone else other than your spouse, they will be taxed at ordinary income tax rates as they receive those distributions from an IRA, just as you would have been had you taken income from that IRA. However, if you leave your IRA assets directly to charity, again, no taxes there. So 100% of it passes tax-free to the charity. So if you're looking at your full estate plan and all of your assets and deciding, okay, what assets am I going to leave to whom, or which are going to go into my estate versus which do I want to go directly to charity, IRAs or any tax deferred accounts are really the best gifts to leave to charity because they will pass 100% tax-free. Whereas leaving them to individuals, they will be taxed on that. All right, and the last thing I'll talk about is life income gifts. And so there are there are multiple types of life income gifts and lots of variations, but I've picked kind of the most common ones and the simplest ones just for the sake of this presentation. So there there's something called a charitable gift annuity and a charitable remainder trust. And I'll talk a little bit about the differences of those in just a minute here. But essentially, what this allows you to do is transfer an asset or cash, stock, real estate, crypto, whatever, to a charity and receive income in return for either a period of years or for your lifetime. And then at the end of that, the remainder would go to charity. And so you would receive a partial charitable deduction. You would not receive a full fair market value because you're going to be receiving income on that gift. But the IRS calculates, okay, we think, based on your life expectancy and the payout rate of this gift, we think you'll get X amount of income over the next several years. So they're going to back that out of the gift amount, and that would be your charitable deduction. However, by doing this, you would still get a partial charitable deduction. You would save on capital gains taxes by transferring appreciated assets into this life income gift. You would receive income, or you could name other beneficiaries to receive income for a period of time. And then again, at the end of that period, you would know that the rest would go to support a charity. So I'll talk about a charitable gift annuity first, how it works. So let's say you have appreciated stock and you put that into a charitable gift annuity. Based on your age, you would receive a certain payout rate and you would receive guaranteed income for the rest of your life. When the donor passes, then whatever is left in that charitable gift annuity account would go directly to the charity. And so the benefits of that are that, number one, you get a partial charitable deduction when you transfer those assets into the annuity. Number two, you get income on that for the rest of your life. And so this can work really well if you wanted to secure income as part of your overall portfolio. So if you have appreciated assets, obviously the market has been very turbulent the last several years. It's been a little bit all over the place, and for people who are retired and counting on those assets to be able to meet their expenses for the next several years, they may be a little nervous about that. So somebody might say, okay, I have this appreciated stock over here. I'm going to go ahead and put it into a charitable gift annuity because I know when I do that, I'm going to receive a guaranteed, whatever it is, 6%, 7% a year for the rest of my life. Every quarter that check is going to come, it's going to be the same amount, and that's never going to change. And so that could be, if you have a certain percentage of your portfolio that you want to designate as fixed income, this could be a great fixed income piece of your portfolio. And at the same time, you know that you're supporting a charity at the end. Charitable remainder trust is similar. It's a little bit more complex though. So with a charitable gift annuity, at the time you do the annuity, your payout rate is fixed. It's fixed at the time you make the gift. It never changes. It never goes up or down for the rest of your life. With the charitable remainder trust, you put assets into a trust. And at the end of every year, that trust is valued and you will receive a percentage of that, let's say 5 or 6%. Excuse me. All right, I've been talking too much. No, I'm looking forward to getting into your questions so I can stop talking. No. So with the charitable remainder trust, you do have to set up a separate trust entity. And so you would work with an advisor to set up the trust. You would set the payout rate, whether it's 5 or 6 or 7%. And then you would transfer assets into that trust. So you might put stock into that. You might put appreciated, excuse me. Sorry about that. You might put real estate into a trust or something like that, to where you're wanting to get income back from that. In exchange, you would get a partial charitable deduction. And then for the period of your life or a certain number of years, you would receive income in return. The difference between that and a charitable gift annuity is that the value changes every year. And so if the charitable remainder trust is invested in a portfolio, that's going to go up and down from year to year. And so your payout rates may fluctuate. But the goal would be if you're only taking 5 or 6% of that trust each year, hopefully your investments are making 7 or 8%, that at least over time, the amount of your payments would increase over 10, 15, 20 years, so that the payments you would get in the future are more than you're getting now. And so a charitable means of trust would be good for somebody who's a little bit more comfortable with risk and investing the trust in the market, with the goal that over the long term, they know that's going to earn a little bit more and the payments may be higher in future years. The one other thing I'll note, so similar to gifts of real estate or crypto or some of the other things that I mentioned, so the center or other small nonprofits may not be able to accept a charitable gift annuity or administer one directly. However, there's an organization, there's the National Charitable Gift Annuity Foundation, for example, that the whole reason they're set up is to receive assets to set up charitable gift annuities to benefit other charities. And so if you're interested in looking into something like a charitable gift annuity, there are national foundations who do that, and you can specify that you want it to go to a certain charity or charities when you pass. And so again, the kind of the message with all these gifts is there are organizations or people out there who are set up to help with these. And again, my contact info will be at the end, and you can certainly reach out to get more information about all those. So I know I've covered a lot of different things in a fairly short period of time, and I'm sure we definitely want to get to your questions, and I'm certainly willing to stay on for a few minutes afterwards if we go over 11 o'clock. And so, but yeah, just wanted to thank you again for listening. Again, my phone number is here, my email is here. Feel free to reach out to me as a resource. But I'm going to go ahead and stop sharing now so that we can see everyone, and then we'll take a look at what is in the chat here. And apologize, I got a little frog in my throat earlier, but I think it's good now. So,
John,
all right.
Thank you very much. That was highly informative, probably for many of us, more than we could quite grasp at one time. But we've been starting to get questions in, and we've got at least 3 questions here. The first one is, what do you need to do to set up to receive a gift of property?
Yeah, that's a good question. So
the second question is closely related to that. Third-party real estate transactions, what is their typical fee structure?
Sure. Yeah, it'll be different for different organizations. I guess on the first question of what do you need to do to set up to receive a gift of property, technically, Don, you or the center could accept a gift of real estate property. The main thing that needs to happen is that the donor, well, there's several things that need to happen, but in terms of the actual transaction, the donor would just sign the deed of trust over from themselves to your organization so that you are the owner of that property. And then they would get a qualified appraisal, and they would take that charitable income tax deduction for the fair market value based on that qualified appraisal. However, then you would be the owner of that property. So you would have to maintain it, you'd have to pay the taxes, you'd have to turn around and sell the property. And so if you don't have kind of an in-house real estate team like we do, that might not be something you want to take on. The other piece with gifts of property is, once you accept that gift of real estate, you're part of that chain of title. If there were anything that were to go wrong with that property, if there are environmental concerns, if they found, oil or gas issues or whatever it is, if somebody is looking to be compensated for something, they can go all the way back through the chain of title, not just to the current or previous owner, but to anyone who has ever owned that property. And so if you, as an organization, decide to accept real estate, you just have to know that you're going to be part of that chain of title, and you really have to do your due diligence and know everything about the property to accept it, which is why I always recommend for smaller organizations, not only because of the kind of the ease of the transaction, while having somebody else handle it is easy. Handling it yourself is not easy. But just because of the the amount of work involved, the risk, the liability issues. Again, you know, there are at least a couple organizations that I know of who are happy to accept gifts of real estate. They turn around and sell it. I know Sharing Connection, I don't believe, I'm not sure what their fee structure is, but it's fairly minimal. I mean, I would say it's probably less than 5% of the value of the property that they would take in order to you know, turn around and sell it and provide the proceeds. And so the charity would get the vast majority of the proceeds from that without having to deal with all the other headaches of it. Let's see here. So there's a question about, let's say we want to designate the center as a beneficiary of one of our accounts. When is it best to inform the center of this plan gift? I would say, I mean, Don, that's a question for you, but I would say, you know, as soon as you've done it, I know that you would love to hear about it and include those people in your list of plan giving donors.
Oh, you're right. We would appreciate that. And the best time is today, but tomorrow will be fine too. So thank you.
Yeah.
Any of you have other questions, can add them in the chat, or you can unmute yourself and ask John the question directly right now.
Yeah. So Bill had a question. How does your message about the value of plan giving change when speaking to a younger person versus an older person? Many younger people are inclined to wait until later. Yeah, I agree with that in general. I think it's interesting in the field of plan giving, you know, historically, we've always looked at older individuals in terms of, you know, when people are creating or updating their plans, or when they're able to give from their IRAs, or when they're at the point where they have appreciated stock or real estate or some of these things. But I think a lot of that has changed. I mean, I think, again, with not only the amount of wealth that's created, being created in the kind of the Gen X and the millennial generations very early on. So you have a lot of entrepreneurs, or you have people that have had success in investing or in the crypto space. Not so much anymore, but a couple of years ago, crypto was very, very high. And so, but there are younger people with wealth who, you know, in their 30s, 40s, who are approaching us and saying, hey, I have this asset. You know, I want to make a gift. I don't want to have to pay taxes on this. What can I do? Or there are people, again, younger people who may not be married, may not have kids, and they're saying, hey, I don't have a will or estate plan, but, you know, I want to make sure that the charities, you know, that I care about are taken care of. And so I'm going to update my beneficiary designations, or I'm going to go online and use this free tool to set up a will, and I'm going to name you, you know, as beneficiary of my estate. And so I think it just depends on who the person is in their situation, but certainly younger people can make, you know, gifts of appreciated stock, or can make gifts, you know, via cryptocurrency, or can set up wills as early as they really start having assets and accumulating an estate. So I think the message has changed just in the fact that it's become a lot easier to set up donor advised funds. The minimums for those are much lower. It's much easier to transfer appreciated stock now. And you don't have to go, you know, make an appointment and sit down with an attorney and pay $1,000 to make a will anymore. You can go online and do that for free in about 20 minutes. So I think that's changed the game a little bit.
We're very appreciative of Dr. Hamm and John for their presentations, but we do want to acknowledge your presence and appreciation for all of you who come to join us today. It has truly been an informative and inspiring session. We're grateful again for the participation of all of you and for John Kraus's presentation.